These figures are closely watched as they often set the tone for the euro and broader European market trends. Its worst performance since early November 2024. If we remain within this current market structure, we could start confirming a new bearish leg for the euro. Welcome to this week's market breakdown. I'm Maisa Martinez, trader and market analyst at xChief. In today's video, we'll dive into the latest global market developments and examine key technical levels on the US dollar index, the S&P 500, Euro USD, and Bitcoin, with markets reacting to renewed trade negotiations, shifting inflation expectations, and surprising earning results. There's a lot to cover and a lot of opportunities to watch. If you're looking to stay ahead of the curve, this is the analysis you need. It's always important to understand how the fundamentals are happening and which days are volatile to be prepared. So we're going to see the economic calendar, and don't forget all the hours you're going to see are based on GMT -5, which is part of the New York trading session. This week's economic calendar focuses on key PMI and labor market data that could influence market sentiment. On Thursday at 2:15 a.m., we will start with France releasing its flash manufacturing and services PMI, which give us an early look into the health of their business sectors. Then at 2:30 a.m., Germany will publish its own flash manufacturing and services PMIs, offering a similar snapshot of activity in Europe's largest economy. These figures are closely watched as they often set the tone for the euro and broader European market trends. Later at 7:30 a.m., the US will release weekly unemployment claims, an important gauge of the labor market strength. Right after that, at 8:45 a.m., we'll get the US flash manufacturing and services PMIs. These numbers help investors assess if business conditions are expanding or contracting, and together they provide insight into the momentum of the US economy. These events can create volatility in the market, so traders should be prepared. Now let's see which were the most important fundamentals of the week. US stock futures were muted on Friday, following a mixed session the day before. Despite a new trade agreement between the US and China, markets remain cautious as investors fear more twists could emerge in the ongoing trade saga. However, Barclays has now dropped its forecast of a US recession this year, citing improved economic outlooks and reduced uncertainty. Investors are now turning their attention to the University of Michigan's preliminary consumer sentiment reading, which has been falling in recent months due to concerns over tariffs and inflation. On the corporate side, shares of Applied Materials fell during after-hours trading after reporting lower than expected sales in its semiconductor systems segment. The company continues to feel the effects of US restrictions on chip-making exports to China. Despite the challenging trade environment, Applied guided Q3 revenue close to $7.2 billion, suggesting demand remains relatively stable for now. Meanwhile, gold prices dipped sharply this week as easing tensions between the US and China reduced safe haven demand. Traders took profits after recent record highs, while a stronger US dollar and rising treasury yields also added pressure. Spot gold fell nearly 3.2% this week, its worst performance since early November 2024. All eyes now turn to the upcoming economic data and how trade policy continues to evolve, as these factors will be key drivers for market direction in the coming sessions. Now let's continue with the technical analysis of the markets, and we will start with the DXY, which is the US dollar index. As I mentioned last week, it was crucial for the dollar to break above the 100.2076 level. This is a key high that could signal a shift in market structure. From bearish to bullish, it is essential for this asset to remain above 19.172 in order to sustain a bullish structure. This same level has recently acted as a support. As you can see here, it acted as a resistance first, then another resistance, and then after we had the break above the level, we saw that it acted as a support here and here. That makes it even more critical for the dollar to attempt a bullish move in the coming week. Interesting targets for the dollar next week could be 101.835. We can also maintain our previous targets at 102.247 and set a final target at 103.534. Achieving these levels would paint a very bullish scenario for the dollar's strength. With that in mind, remember that any asset that moves inversely to the dollar could weaken in response to this potential bullish movement. Assets such as the euro against the dollar or the Australian dollar against the US dollar could be impacted, so keep that in mind. As for potential bearish targets for the DXY this week, we can still watch the 100.276 level, the support I just mentioned before. Some traders might also identify that area as a key level. The next level I've marked is a liquidity zone around 99.172. Below that we have 98.929 and finally 97.921. A level that could be harder to reach, but if we see negative fundamentals like renewed trade tensions between the US and China, that could weigh heavily on the dollar and potentially push it lower. With S&P 500, we've seen a clearly bullish move. We've managed to break through our target at $5,786, which finally signals a shift away from the previous bearish structure. Now, to be clear, it wasn't a long-standing downtrend, not at all, but rather a short-term bearish structure that developed during a period of fear and overall negative sentiment among S&P 500 traders. What I'm expecting from here is that price could potentially continue upward toward the next target 5,968. However, we should stay alert for a possible pullback. This pullback might attempt to fill in some of the zones that were left behind during the recent move. The next zone worth discussing lies within this vacuum block around $5,730. Below that, we have additional potential pullback levels at 5,544, 5,433, 5,324 and 5,186, areas where price might retrace or correct in the short term. It's important to highlight that strong corrections might be difficult to achieve now that the S&P 500 has gained bullish momentum and shifted from a bearish to a bullish structure. The market is showing renewed risk appetite, and as we've just seen, with gold continuing to decline and weaken, risk on assets like the S&P 500 could continue their recovery. Another nearby target to keep in mind is $6,144, which, let's remember, marks the all-time high for the S&P 500. Let's move on to the euro. As I just mentioned, everything happening with the dollar is reflected in the euro, but in the opposite direction. That means the euro has experienced a significant drop. We have already hit two of our downside targets. The first one was located here, 1.12642, and the second one being 1.10875, a reaction zone where the euro took in liquidity and attempted a recovery. However, after that bounce, look at how price reacts to this area here. We see at least two rejections at the same price level that we have been following, located at 1.12642. Now we can say that this level is acting as a resistance. This tells us we are now facing a key level zone, and moving forward, it might be difficult for the euro to break above it. If we remain within this current market structure, we could start confirming a new bearish leg for the euro. That's why I'd like us to maintain a bearish outlook for now. Downside targets could include the 1.10875 level, the same zone where price recently bounced. The next levels would be 1.10115, 1.08844, and 1.07783. 3. Of course, there are additional bearish targets further down, but for now, considering the current environment and the fact that we may not see an immediate or strong recovery in the dollar, we could expect any drop in the euro to happen gradually, reaching these targets step by step. Finally, let's take a look at Bitcoin that so far hasn't made a clear decision to either break higher or lower. When we see this kind of price behavior, we need to understand that we're likely in a consolidation phase, possibly setting up for a strong bullish continuation. In this scenario, we should be watching closely to see if price begins to show signs of movement. And yes, it continues to hold this range with a bias to the upside. There are several factors supporting a bullish outlook for Bitcoin. First, the current market structure remains clearly bullish. Second, even after a potential pullback setup, price has instead stayed at this accumulation range, as you can see here, showing strength. And third, in the broader context, with improving sentiment around tariffs and growing risk appetite, as I've discussed, Bitcoin still has room to move higher. Personally, I would maintain a bullish bias and watch for upside targets. The first target is $106,159, followed by $109,358. On the downside, if we do get a correction, bearish targets could be set at $99,517, then $97,363, and finally a deeper liquidity zone down at $93,793. That last level may be hard to reach, but it's a high liquidity area where Bitcoin could dip briefly before gathering momentum for stronger move up. Thank you for joining me in this week's analysis. If you found this content helpful, be sure to like the video, subscribe to the channel, and click the bell so you don't miss any future updates. And if you want to trade with the best conditions and support, open your account now at xChief.com. Until next time, trade smart and stay informed.